Those three numbers describe what just happened in the silver market in less than 3 days. On Monday, silver was trading near $95 an ounce. By Tuesday, it had collapsed to around $76, and now, only a short time later, it is hovering around $85. That is nearly a $20 price range in just a few days. In most markets, a move like that would take months. In silver, it happened almost overnight, and when people see something like this, the reaction is always the same: confusion. One day the market looks like it is collapsing, the next day it looks like it is recovering. Social media flips from panic to excitement, and back again. But here's the reality. This kind of chaos is not random. Extreme volatility almost always appears when something much bigger is happening beneath the surface. And today, I'm going to show you the data that explains what is really going on. Because behind the wild price swings, behind the fear and the excitement, there's a pattern forming in the silver market right now. A pattern that has appeared only a few times in the past 2 decades. And every time it appeared before, it ended with one of the most aggressive price moves in the entire metals market. But before we talk about where silver might go next, we need to understand what just happened. Because the story starts with the crash. The sudden drop at the beginning of the week, silver pushed into the mid-$90 range. That level was important. Many traders had been watching it because it represented a key resistance zone where large positions tend to build up. When prices reach levels like that, the market often becomes extremely fragile. Why? Because a large portion of traders are using leverage. Leverage magnifies gains, but it also magnifies losses. And when the price suddenly moves against those leveraged positions, the market experiences something called forced liquidation. This is where brokers automatically close positions when traders no longer have enough collateral to support them. In simple terms, people are forced to sell, and when a wave of forced selling begins, the price can fall much faster than normal. That is exactly what happened. Within hours, silver dropped from the mid-90s into the mid-70s. For many investors, it felt like the floor had disappeared beneath the market. But something interesting happened at the bottom. The selling suddenly slowed down. Then the price began to climb again. By the time the market stabilized, silver had already recovered several dollars from the low. And that raises the most important question. Who was buying during the crash? Because in every major sell-off, there are always two sides. Someone is selling, and someone else is buying everything that gets dumped. The hidden buyers. Most people watching the price charts never see this part of the story. They see red candles. They see panic. They assume everyone is selling. But the truth is more complicated. Behind the scenes, the futures market records something called delivery notices. These notices show which institutions are taking ownership of actual physical silver. And the numbers from the recent trading session are extremely interesting. During the same period when silver prices were collapsing, several large financial institutions stepped in to take delivery of significant amounts of physical metal. When you add up the contracts involved, the value reaches well over $100 million worth of silver changing hands. Let that sink in. While the market was falling, while retail traders were panicking, major institutions were quietly buying physical metal. Now think about that logically. If a bank truly believed the price of silver was about to collapse even further, why would it spend tens of millions of dollars acquiring it? Institutions do not commit that kind of capital without a reason. And that is where the story becomes much more interesting. Because the buying did not happen in isolation. It happened at the same time as something else, something happening inside the silver vault system, the silver leaving the vaults. Every day, the major metals exchanges publish reports showing how much metal is stored inside their vault networks. These vaults contain the physical supply that can be used to settle futures contracts. In other words, they represent the deliverable inventory of silver. When metal enters the vault system, supply increases. When metal leaves the vault system, supply decreases. During the same period as the price crash, millions of ounces of silver were withdrawn from these vaults. Vault after vault reported large reductions in stored metal. When you combine all of the movements together, the total decline reached nearly 3 million ounces in a single day. That is not a small number, and it creates an important contradiction, because normally when prices fall sharply, demand weakens. But here we are seeing the opposite. Prices fell, yet physical metal was still being removed from storage, which suggests that someone wanted that silver outside the exchange system. And when physical demand remains strong while paper prices are falling, the market can become unstable, because the paper market and the physical market begin moving in different directions. The collapse in open interest. There is one more piece of data that helps explain what is happening. Open interest. Open interest represents the total number of futures contracts that are currently active in the market. When open interest rises, it usually means traders are opening new positions. And when open interest falls, it means positions are being closed. After the recent crash, silver's open interest dropped dramatically. In fact, it fell to one of the lowest levels seen in more than a decade. That tells us something extremely important. Many of the leveraged traders who had been driving the previous rally were forced out of their positions. Their trades were liquidated during the collapse. And when that happens, it changes the structure of the market. Because once those leveraged positions disappear, the selling pressure that pushed prices down begins to fade. The weak hands are gone. What remains are the participants who were willing to hold through the volatility. And historically, moments like this have often marked the transition between panic selling and the next phase of a market move, but we are not finished yet. Because when you combine all three pieces of data, the picture becomes clearer. Institutional buying, metal leaving vaults, open interest collapsing. Those three signals appearing at the same time are extremely rare, and when they do appear together, they often indicate that the market is going through a process known as transfer of ownership. The transfer phase in volatile markets, assets often move from one group of investors to another. During the rally phase, speculative traders accumulate positions. Prices rise quickly because leverage magnifies the buying power. But when the correction arrives, those leveraged traders are usually the first to exit. They sell into the decline, and their positions are often absorbed by larger institutions with deeper capital reserves. In other words, the asset moves from short-term traders to long-term holders. This transition is rarely calm. It usually looks exactly like what we are seeing right now. Violent swings, sharp drops, fast recoveries. Each move shakes out another group of participants, and each wave of selling allows stronger buyers to accumulate more supply. If that process continues long enough, the market eventually stabilizes, and when it does, the next major move begins. But the key question remains, what direction will that move take? What happens after the panic? Now that we have looked at the crash, the vault withdrawals, and the institutional buying, we need to talk about the bigger question. What usually happens after a moment like this? Because what we are seeing right now in the silver market is not new. In fact, if you go back through the history of precious metals markets, you will find that this exact sequence of events has happened several times before. And every time it happened, it followed almost the same script. First, prices rally quickly. Then leverage builds up inside the market. After that, something triggers a sudden crash. The crash forces leveraged traders out of their positions. Open interest collapses. Volatility explodes. And while everyone else is focused on the falling price, institutions quietly accumulate physical metal. Then comes the final phase. The phase most people never see coming. The rebound. To understand what that might look like, we need to go back in time for a moment. The 2008 silver shock in 2008. During the global financial crisis, silver experienced one of the most violent crashes in its modern history. At the beginning of that year, silver was trading above $20 per ounce. Then the financial system began to crack. Banks failed. Liquidity disappeared. Markets panicked. Within a matter of months, silver collapsed to around $8 per ounce. That was a drop of more than 60%. At the time, many investors believed silver was finished. Analysts were publishing bearish forecasts. Media headlines were full of fear. But behind the scenes, something very different was happening. Large financial institutions and long-term investors were accumulating physical metal at the lowest prices. They were not reacting emotionally to the crash. They were using it as an opportunity. And what happened next surprised almost everyone. Over the following years, silver did not stay at $8. It did not even stay near $20. Instead, the price began one of the most aggressive rallies in the history of the metal. By 2011, silver had surged to nearly $49 per ounce, a six-fold increase from the crash lows. The panic of 2008 was not the end of the story. It was the beginning of the next move. The 2020 crash fast forward to another crisis. The year 2020. When the global economy suddenly shut down, financial markets experienced another wave of extreme volatility. Silver was not spared. In just a few weeks, the price fell from around $18 to nearly $12. Once again, fear dominated the headlines. Investors were dumping assets everywhere, but if you looked carefully at the physical market during that time, the pattern looked familiar. Demand for real metal surged. Dealers struggled to keep inventory. Institutions were quietly accumulating, and just like in 2008, the crash eventually turned into something else. Within months, silver rebounded sharply. By the end of the rally, prices had climbed back toward $30 per ounce. Once again, the panic phase was followed by a powerful recovery. Why these patterns? Repeat, you might be wondering why this cycle keeps happening. Why do markets crash so violently, only to recover later? The answer lies in the structure of the futures market itself. The silver market is not driven only by physical metal. A huge portion of trading activity comes from paper contracts. These contracts allow traders to control large amounts of silver with relatively small amounts of capital. This creates leverage. Leverage makes rallies faster, but it also makes crashes more severe. And when prices fall suddenly, leveraged traders cannot hold their positions. They are forced to sell. That selling accelerates the decline. But here's the key detail. The forced selling is temporary. Once those positions are liquidated, the selling pressure disappears. And when the market stabilizes, the price begins reflecting the underlying supply and demand again. If physical demand remains strong during the crash, the rebound can be extremely powerful. The current setup. Now, let's bring the discussion back to the present. Look again at the three signals we discussed earlier. Institutional buying during the crash, millions of ounces leaving the vault system, open interest dropping to extremely low levels. These signals together suggest that the market is currently going through a reset phase. The speculative excess has been flushed out. The leveraged positions have been reduced, and stronger buyers appear to be accumulating supply. That does not mean the price will immediately skyrocket tomorrow. Markets rarely move in straight lines. Volatility could continue. Silver could still swing several dollars, up or down as traders react to news and economic developments. But historically, when the market reaches this stage of the cycle, the most intense selling pressure has already occurred. The role of psychology. There's another factor that plays a major role in moments like this: human psychology. Financial markets are not just numbers and charts. They are driven by emotions. Fear and greed constantly push prices too far in both directions. When prices rise quickly, people become overly optimistic. They believe the trend will continue forever. When prices crash, the opposite happens. Fear spreads rapidly. People assume the worst possible outcome. The irony is that these emotional reactions often create the opportunities that institutions take advantage of. While the crowd is reacting to fear, long-term investors focus on value. They ask a simple question: has the fundamental story changed? If the answer is no, then a lower price simply means a better entry point. The bigger forces behind silver right now, several global factors are still supporting demand for precious metals. Geopolitical tensions remain high. Energy markets are unstable. Inflation concerns have not disappeared, and central banks around the world continue to hold large reserves of gold and silver-related assets. Silver also has a unique advantage compared to many other metals. It is both a monetary metal and an industrial metal. It is used in electronics, solar panels, medical technology, and many other industries. That dual role means demand can come from multiple directions at the same time. When financial uncertainty rises, investors buy silver as a store of value. When industrial activity increases, manufacturers buy it as a raw material. This combination often amplifies price movements during major economic shifts. The range. That everyone is watching, right now, the silver market appears to be trading inside a wide range. The lower boundary sits somewhere in the $70 area. The upper boundary has recently been near the mid-90s. Inside that range, the price is moving with extreme volatility. But ranges like this do not last forever. They are temporary structures, where buyers and sellers fight for control. Eventually, the market chooses a direction. When that breakout happens, the move can be extremely fast, because once the price escapes the range, traders who were waiting on the sidelines rush back into the market. That surge of participation can accelerate the trend dramatically. What smart investors? Watch instead of focusing only on daily price movements. Experienced investors often monitor a few key indicators. First, physical demand. Are institutions and long-term holders accumulating metal? Second, inventory levels. Is the supply inside vault systems shrinking or expanding? Third, market positioning. Are leveraged traders dominating the market, or has most of that leverage been removed? Right now, the data suggests that leverage has already been reduced significantly. And when leverage disappears, markets tend to become more stable before the next major move begins. The important lesson. The most important lesson from all of this is simple. Short-term volatility does not always reflect the long-term direction of a market. In fact, some of the most powerful rallies in financial history began immediately after moments of extreme fear. The silver market has experienced this pattern multiple times: a rapid rally, a violent crash, a period of uncertainty, and then a move that surprises almost everyone. Whether the current market will follow that exact path remains to be seen. But the ingredients that have appeared before major moves in the past are starting to appear again. And that is why so many experienced observers are watching the silver market very closely right now. Because when volatility reaches extreme levels, it often means the market is approaching a turning point. The only question left is which direction that turning point will take. And when the answer finally becomes clear, the move may happen faster than anyone expects.